it's been a split market. It's been split in various different ways. I mean, there were a few months this year when small caps seemed like the haven. Since June, that's not been the case. So I think you can quibble with the kind of makeup of the market, but the fact that the big cap indexes more or less stay calm, more or less stay in these kind of slow, orderly uptrends, I think it's hard to have an edge in saying, okay, this is the critical weakness in there that I've identified. But there's no doubt you can't really get away from the fact banks been weak, smaller stocks been weak, and what to make of it, I think, is the big question now.
Oil is a component, some of this, right?
It is. Oil, I mean, look, you're getting retail hit today, right, on a couple of different things with the wage stuff. Oil doesn't help on that front. Oil stocks doing well, although underperforming the commodity. So, you know, that's kind of helping, and you can kind of see almost oil and banks trade like a seesaw some days. It's a little bit of an odd relationship. So it all gets thrown into the mix. And meantime, people have kind of called for some kind of more wholesale rotation, let's say, you know, out of the big cap techs and into other stuff. And that really hasn't happened. It's only been spotty in terms of that kind of activity.
In Europe, it doesn't seem like any of Italy's budget worries are really bleeding over into the U.S. markets, at least not the last several days.
Not yet. No, exactly. It seems like it's been sort of sequestered. I'm looking at, you know, credit stress indicators, stuff that would suggest that it's kind of filtering through the capital markets into our markets. And I would say not yet, although, you know, maybe you can, you know, attribute some of the U.S. banks' weakness to the fact that European banks just can't get off the mat.
As you're talking, let's change the lower third because we did get that record high on the Dow. Not quite for the S&P, got to get up to 2940 or so.
2940 is about the intraday high, and 2930 and change. It's you know, it's sort of interesting. I mean, anything you would kind of slice up in terms of the data to say what are the indications for what the fourth quarter should be, they all net out to probably leaning to the upside, but none of the market action seems like it's kind of geared up to accelerate from here.
When you look at the Russell versus the S&P, back to that for a moment, is there anything in particular that's made the larger stocks better able to weather, say, some effect, whether it is concern about tariffs, something with currencies, trade issues? I don't know. Anything in particular you see?
I mean, honestly, I think, first of all, it's interesting. On a year-to-date basis, the Russell 2000 and the S&P are up almost the same amount. It's just been this weird cadence of one rushing ahead and then falling back to the pack. I think cost pressures are going to hit the smaller companies harder. Also, the Russell 2000 is far more weighted in financial than the S&P 500. So there's a sector effect. You don't have the impact of those huge dominant mega cap growth companies that really are powering a lot of the aggregate gains in the S&P 500. So all that stuff is working against the smaller stocks at this point.
If you look into the NASDAQ 100, the leaders, a lot of them, the chip names here. Intel, of course, up there very higher by more than 4%.
A bounce, it seems like.
Yeah.
I mean, I think that's one of those questions that, you know, when the chip stocks and the semi-cap equipment stocks rolled over, does that tell you something about the cycle? Or is it just another one of these kind of stealth corrections of one group that's going to resume the uptrend at some point? Yeah. So.